Hello and welcome to this daily market commentary for Thursday, the 23rd of January 2020. Despite the continuation of President Trump's impeachment trial, Australian employment data, the Economic Forum in Davos, and the ECB monetary policy statement, all attention is on the spread of the Wuhan coronavirus. The city of Wuhan itself has been placed under total lockdown, as has a second city, Huanggang. Cases have been reported as far apart as Saudi Arabia, Thailand, the UK and the US. Doctors in Wuhan have expressed alarm at how quickly the virus is spreading. China now has more than 600 confirmed cases, with 17 reported deaths so far. The markets are scared, although not yet running for the hills. Equities in Asia and Europe would all register losses on the day, with the Shanghai index leading losses down 2.75%. For FX, the first focus would be on the Australian dollar, as Australia released employment data for December. The number was better than expected, up 28,900 as opposed to estimates of 15,000. The Aussie dollar immediately jumped from 68.45 up to a high of 68.78, with several analysts immediately revising their expectations for the timing of a rate cut. However, the Aussie would give up much of those gains during the day as risk sentiment turned negative. Next up, we had the ECB rates announcement. As expected, they left rates unchanged. Euro did see an initial pop during the press conference up to a 111.08, but this was short-lived, and before long, support at 110.70 was broken, en route to a low of 110.37. Dollar yen, which had broken support at 1970 overnight, would continue to move lower as negative risk sentiment would dominate. Selling of yen crosses would take dollar yen down to a low of 109.27. Sterling against the dollar would also move lower from 131.50 to 130.97. And gold, of course, would benefit from all the negativity, rising from 15.52 to 15.68. Wall Street will continue the negative trend in equity markets. The Dow Jones falling by as much as 150 points as Europe went home. A mix of poor earnings from the Travellers Group, coupled with the coronavirus developments, gave traders little reason to buy stocks. However, later in the day, a statement from the WHO, the World Health Organization, that it was, quote unquote, too early to consider this event, coronavirus, a public health emergency of international concern, was enough to calm some traders' nerves. And in fact, both the S&P and NASDAQ would both turn positive, and dollar yen would climb back as high as 109.50. Euro would also rally off its lows back to 110.57, and sterling to 131.25. As yen crosses were bought back. At the end of the day, Wall Street closes with minor losses, and the S&P and the NASDAQ both making small gains. The Dow Jones ending down 26 points, but a decent recovery, obviously, from the 200-point loss it was looking at earlier in the day. So today has seen a couple of significant technical breaks. Dollar yen through 109.70 is certainly one of them, and euro dollar through 110.70. We've looked at dollar yen a couple of times. I've highlighted that 109.70 area. So let's see what euro dollar has to offer. Looking at the hourly chart we have here, we can see euro has not been the most exciting of currency pairs to trade. A 260-point range from 109.80 to 112.40, I guess, has really covered us back to the middle of October of last year. 2020 has actually seen us unable to break below that 110.65.70 support area, but today we did, although it should be said only down as low as the next level support around 110.40. I think I said we made a low actually at 110.37, but we did hold. The question from here is, do we have a false break lower on our hands? Are we going to go and bust back higher again, back above this 110.70 area, or can we expect further attempts at the downside? Hard to say, as the price actions are a little inconclusive. But if we do break this 110.40 area, then 109.80 would certainly be considered the next area of major support. And with that, I hope everyone had a good day, and look forward to speaking with you tomorrow. Cheers.